Okay, doing a little bit of social media posting there. Just trying to get the word out. I'm going live real quick. Wanted to go live today and talk about the recent housing news that came out, the housing starts, and a few other things, but I'm going to keep this pretty short, be about 10 or 15 minutes. If you have any comments, questions, please feel free to post. Use a lot of this. I use a lot of this for later on posting on social media. We do some different things with this. We turn to a podcast. So it is October 17th, 2019. The housing starts news came out for September today. A couple of caveats with that I want everybody to understand. The first thing is that this number always gets adjusted. And it's interesting when you start looking at some of the numbers, but it depends on who you're reading on the news. And I'm going to pull up the screen share. Hopefully it is not going to kill my my audio here. But so here we go. See if I can get this on the layout here properly. But it depends on what you look at, because if you're looking at, for example, what was on here, CNN. Is this one CNN's? U.S. housing market in serious trouble as starts fall sharply in September. Well, folks, there's a couple of different ways to look at this, okay? First off, the housing starts always get adjusted. For example, I'm going to go here. Here's the numbers from Trending Economics. A great place to look at some numbers. Housing starts back in 1 month ago came in at 1.36. They call this an actual number, but actually the number was 1.386. Not a big difference, but a significant enough of a difference to affect that plus or minus number. And this is something I'm going to dive into a little bit again. Now, August was the highest housing starts in 12 years. So think about this logically. So August was the highest housing starts. Do you think it's just this linear line of housing starts that go up every month and they just progressively keep going up and up and up? We're dealing with home builders here. They've got to get permits. They've got to get the houses started. Maybe they really push in 1 month, and then the next month the numbers are a little bit down, and then the next month they're going to go up. The month after that, they might go down. I'm going to show you a graph in a minute that talks about, every quarter they're kind of going like this, or every month they fluctuate. So you have to think about the narrative that people are trying to push. Market Watch had a great article. Housing starts fall, but high permits, low mortgage rates suggest construction slowdown is temporary. CNN, different story. We're in a major trouble here. So just want to take that with a grain of salt, because not all data or how that data is interpreted is equal. So just some things I wanted to point out here. I'd like to pull up guys. Well, I'm not quite getting it to switch, but there is a graph here, and it is in the corner. But so this is the housing starts over a period of time, and this is from the Market Watch article. So these housing starts fluctuate month over month, and really, if you read on the bottom of some of the data, they tell you for housing starts, you need 3 to 6 months of data to really see what's happening. So what's happening now, these numbers initially come out, they're lower than they were last month, lower than analyst expectations. I talk about this all the time. It's pretty crazy stuff. But the fact is that we have a huge demand for houses. It's going to keep housing going very strong for a long time. There's a great article in Forbes that just came out recently that I'm going to show on here that is the let's see if I can share it. Okay, here's a Forbes article. And the title of this article, I posted this on my LinkedIn yesterday, got a lot of engagement with this, was the biggest boom in housing history has just begun. The thesis of this article, now this guy's talking about housing stocks, why you should be investing in housing stocks. These guys are pretty accurate. They've been saying this for months to invest in these housing stocks because there is a boom in housing. In fact, if you really want to be smart, start looking at some gravel and pavement companies and things like that. So it says in here, I'm not an investment advisor. I do not know anything about investing in stocks. It's not my preferential investment vehicle. Real estate is. But since up until 2009, we were building about 1.5 million homes a month. A year. After 2009, we've been building on an average of 900 homes a year. This year, we're going to build 1.25, 1.3, 1.1, somewhere in that number. It's still below the numbers that we need. The housing is going to stay strong. It's a great opportunity for investors. Some things I've talked about in the past. I don't know if I've talked about it on LinkedIn Live recently, but where do you want to invest? Where do you want to be investing if you're a real estate investor? You really want to start looking at these areas that I would call, or that what the Urban Land Institute calls hipsterbia. So these areas are great places to invest because they're outlier areas outside of either major metropolitan areas or markets where there's great jobs, there's a great work and live community, and that's where investors are moving to invest, and that's why there's such great opportunities. We have a lot of funds that are starting to buy there. We're starting to buy there. We're looking at different markets like around Birmingham, Alabama, not in Birmingham, but around Birmingham, in these nice suburbs that have this good live, work, play. Greenville, South Carolina, Columbia, South Carolina. Indianapolis is a market that a lot of guys are looking at. Columbus, Atlanta, the suburbs of Atlanta. So when you go into some of these other cities, and I wouldn't even call it a suburb, I would call it an actual community outside of these larger areas that you get a lot of businesses that are growing and moving into these areas, and they're great, great, great places to invest. And I'm going to say this till I'm blue in the face. There is so much opportunity right now for investing in single family rentals. Be careful of the news that you're reading and understand, I don't care what your political affiliation is, but think about the narrative. And thank you, Robert Schiller, for really putting a spotlight on this. Think about the economic narrative that's trying to be pushed. We're in an election year. There's some people who'd love to see a recession. It's sad, but for their political gains, they'd like to see the next president or see the current president unseated. And so they're going to push a narrative that is recession, things aren't going well. And even if there's a recession, doesn't mean there has to be a housing crash. Look at what's happened in the past recession. So there is this narrative out there, and I've been caught up in it before, that the last recession was caused by housing. That is not true. The housing crash was a byproduct of the last recession. The no aversion to risk. That was one of the big things. The banks, the lenders all across the spectrum, the bonds, housing was a big part of it, but housing did not cause the last recession. That is a narrative that's being pushed. That's caused a lot of people to be scared now. And now you start getting this recession narrative, and you start getting a lot of people now thinking, oh my gosh, there's going to be a recession. I'm going to have to pull back in housing. And it starts to become viral, regardless of what's happening with jobs, the economy. I don't like to include stocks in this because what does it matter today to most of the people if the stock market went down today? Did your employer cut your wages? Did your value of your real estate go down? Now, if you own stocks and bonds, yeah, there's a little bit of risk there, but you shouldn't have everything in one. And in fact, that's why you see a lot of big money moving into real estate because it's so much more stable and it's less volatile, especially single family. We talk about multifamily. Multifamily is still going to stay strong too because there's so much demand. You have millennials. The millennial median age of millennials is 34 years old. It can't be denied. All of these millennials aren't just living in their parents' basement. Okay, they're starting to have families, and when they have families, they want more stable housing. That doesn't necessarily mean they're all going to buy, but a lot of them are going to try to buy, and the ones that can't are going to rent, and they're going to want to rent professionally managed single family homes in nice communities where they have a great live, work, play environment. Again, called hipsterbia. I don't know if I like that name, but it is what it is. So take a step back on the fear of the housing market crashing. Even if there's a recession, does a recession always affect the entire market? We see a tech bubble happening, all these IPOs. That's affecting the San Francisco tech markets, Seattle markets, a little bit in Denver, not really much, but in New York, Florida, all these high-end markets. That it's not just tech. It's also a lot of speculation was going on. You've got low interest rates. You've got developers that are building huge buildings of multi-million-dollar condos of $2, $4, $5, $10 million condos each that have the building next to it can't even sell 50%. So that's an issue. But is that going to drag down the whole economy of all of housing? No, because it's in a different segment. So just want to put all that out there that it drives me crazy because the housing start news that came out today, it has been interpreted 5 different ways. Half the people are saying it's bad. Some people will say it's bad, give a little caveat at the bottom saying, well, it's not that bad. When you look at these numbers, you have some deviations in some of the housing start numbers. I don't know if it's going to show it here, but it's really interesting because there might be a deviation of 10% that they're affecting. Could be the deviation of the number. They just don't know when the initial housing numbers come out. They don't know what the actual numbers are going to be until they look back. I mean, even 1 month, but more like 3, 4, 5, 6 months. And then they can really kind of tell what's going on. So don't listen to all the news that's out there. We have investors that are investing at scale all over the country. And a lot of people will come to me and say, well, those guys have lower cost of capital. They're able to invest and buy more. Yeah, maybe, but they can't compete with a local investor in a local market that is buying, that can have lower overhead, because while these larger funds have a lot of scale, they have a lot more overhead. And so their expense ratios they operate on are probably 5 to 7% higher than a small investor. So it's amazing opportunities. And now you can go and invest in multiple markets around the country. You can, you don't have to be near your geographic location. So anyways, want to throw that out there. And add on top of all this that we've got record low interest rates, and this helps investors. This helps home buyers. Because of the supply issue, affordability is still an issue. It's interesting when you start looking into things like car loans and student loans and things like that. I mean, yeah, student loans are affecting things, but those are going to start to work themselves out. Car loans, yeah, there's a lot of concern because there is higher delinquencies, almost record low default numbers, but you have, because of the length of car loans going up to 7 years, you have it's people are getting all kinds of loans for more expensive cars. I think that market's going to change a little bit. But, when you look at the delinquencies, a lot of the delinquencies are not necessarily people who own houses. So that doesn't necessarily affect the housing market as much. I think looking at the type of investments that you want to do on a single family rental, I would stay in that 100,000 to 250,000 range. It's interesting, if there is a recession and people need to change their housing, especially on renting, they may go down from a $2,500 a month rent to a $2,000 or $1,700 or $1,500 a month rent. So if you're in that good range, there's less risk. But the fact is, there's a huge demand for housing. The population growth is not keeping up. Millennials are at the medium prime age to start buying houses. And this is going to keep the housing market very strong for, I think, years to come. I mean, the train is just starting. And, thank you for, in Forbes, if you search housing boom, you'll get an article by Stephen McBride by the Risk Hedge Report. And Stephen does a great job laying out the argument of why the housing is not going to crash. I've seen some other articles I don't even want to mention that lay out why we're going to go into a housing decline, and they pull out one piece of information here and one here, take it out of context, put it together, and then come up with a thesis of why we're having a housing crash. For example, taking all of the top tier markets around the country, meaning the most expensive markets, and then saying, well, look, they've declined. Well, in San Francisco, it's actually come back down to a normal number. The people buying houses in the Bay Area are now the ones that actually need them, not the speculators as much. So it's sad that you need a housing decline to bring it down to normal, but there's been a tech bubble that's been going on, especially with these IPOs, tons of IPOs that are doing terrible. And I think I talked about this most recently on one of my LinkedIn Live shows. I actually don't remember, but all these IPOs were overvalued. Some of the things that SoftBank did was really interesting, because if you did this yourselves, you'd probably go to jail. But they buy a stock at a certain valuation, they get financing, or they get their other investors who invest at the valuation of the stock that they own. So they invest into a company like WeWork at an inflated valuation, and now they can leverage that higher valuation, and then it just keeps going like this, and the companies aren't making any money. I think that time is starting to wane. And now it's funny where I saw some open letter that was written by a bunch of tech companies saying they want to be profitable. Great. Sounds good. So anyway, I'm going to cut this short. Really appreciate your time. Again, my focus is on serving our investors that we work with that are buying. I'm looking to buy investment properties, single family rentals, portfolios, one-offs, whatever, in multiple markets around the country. If you are an investor and you're holding on to a portfolio, I couldn't advise you and say now is the time you have to sell. If you want to sell, you can get fair market value. I think that you've got to look at if you're buying, I think you've got to look at the markets you're in, be conservative on your appreciation and your rent increases that you're going to model into your investments, because I think that if there's a recession coming at some point, I don't know when, that's going to slow down. So appreciation isn't going to keep going like this; it's going to go like that. Take the foot off the accelerator a little bit, but 3.62% is the average appreciation since 1998, I believe, that we calculated, and that's great appreciation. Add a percent or two on rent appreciation, and it's awesome. Plus, you're getting your return. Things do great. So, thanks for watching. If you need to get in touch with me, LinkedIn is the number one. 95% of my communication is on LinkedIn outside of my company. So look me up on LinkedIn. Look up renterswarehouse.com. Go to our website. We've got some great things going on our site with our investor marketplace. And look me up. I appreciate you listening to the show. If you're watching it as a recording, if you're listening to it as a podcast, awesome. Again, I'm Noel Christopher, Senior Vice President of Portfolio Services with Renters Warehouse. And that's it. Thanks for listening.